non-banking financial sector, another important topic covered in your economic survey. Regarding non-banking financial sector, economic survey says that after growing very fast in the year financial year 2017-18, the first half of 2018 and in first half of 2018 there have been growth in the non-banking financial sector. From the second half of 2018 onwards, the FX sector, non-banking financial sector, has been decelerated very sharply. Okay, the growth of loans from Nbfc have declined from 27.6% in September 2018 to 21.6% in December 2018 and further to 9.9% in September 2019. So that's a steep decline in the NBFC loan growth. Okay. Then regarding another important point regarding, so what happening in the last in the financial 2019 as well as in the second half of 2018-19 is that there has been a decline in the loan growth of NBFC sector. Now when it comes to the regulatory requirement, okay, NBFCs are need to maintain a capital adequacy ratio of 15%. Okay, so NBFCs capital adequacy ratio requirement is higher than the bank. Okay, so that as part of the against the regulatory requirement of 15%, NBFC's capital adequacy ratio is higher at 19.5% in ending September 2019. Okay, so the capital adequacy ratio of NBFC is quite high. Okay, compared to their regulatory requirement. Now coming to the NPA, gross NPA, there have been a sign that the NPA, non-performing assets of NBFCs has been increasing on a steady basis. It was 5.8% in March 2018. It increased to 6.1% in March 2019 and further to 6.3% at the end of September 2019. So that's a worrying trend. There have been increase in the non-performing assets in the NBFC sector as well as decline in the loan growth. Okay. Now regarding NBFC, economic survey has talked about the funding for NBFC. Okay, from where the NBFC gets their money to lend to the customer. Okay, the source of funding of NBFC, bank borrowings have increased. Okay, bank borrowings from of bank. See, NBFC borrow from bank to lend to its customers. Okay, bank borrowings increased from 5.62 lakh crore to 7.13 lakh crore in the 1 year period starting from October 2018 to 2019. So there have been an increase bank borrowing from the NBFC sector in the last 1 year period of 2018 to 2019. Okay, and but this growth, so there have been a credit growth of from the bank borrowing. Okay, NBFC is borrowing with a credit growth from the bank at a credit percentage of 26.8%, but this bank borrowing is in the period 2019 is lower than the previous borrowing. Okay, so even though the bank the borrowing from the bank is increasing, but it is comparatively lesser compared to the previous period. And then from the mutual fund, okay, so mutual fund used to give money to NBFC through various instruments. Okay, so funding from mutual funds to NBFC has been contracting, or it has been declining since October 2018 onwards. Okay, so after this mini crisis, especially from the ILFS crisis, the mutual fund investment in NBFC sector is on a continuous decline. Okay, so funding from NBFC, funding to NBFC by mutual funds are decreasing from October 2018 onwards. Okay, so if you look into the other source of funding by the NBFC, the market borrowing, the borrowing from the market. Okay, the market borrowing increased from 10.4 lakh crore to 10.5 lakh crore, a slight increase in the period September 2018 to 2019, mainly in the market borrowing. Okay, in the market borrowing, the share of commercial paper has decreased drastically. Okay, so commercial paper and non-convertible debentures, commercial papers and non-convertible debentures are the major market borrowing instrument for NBFC. In the case of commercial paper, there have been a drastic decrease in the market borrowing in the 1 year period mentioned in the economic survey. Similarly, the share of non-convertible debentures increased slightly from 8.61 lakh crore to 9.27 lakh crore. So commercial paper way of funding is decreased, but through non-convertible debentures it is still improving. Okay, so the major funding for NBFC is still through non-convertible debenture. Okay, I covered the concept of non-convertible debenture. Okay, be thorough with these concepts: commercial paper, non-convertible debentures, etc. Okay, they are important concepts, as well as it comes in the news regularly, and it is often mentioned in the economic survey also. So these are the source of funding. So the major source of funding for NBFC is non-convertible debenture, followed by bank borrowing, then commercial paper, etc., mutual fund, etc. Then economic survey, the latest economic survey have come up with a separate box, okay, which says that some important policy changes, okay. RBI have announced some certain important policy changes related to NBFC regulation or supervision. So in order to regulate NBFC by RBI, some many important changes have been introduced by RBI, okay. So after the ILFS crisis, RBI have come up with many norms, okay, to regulate and supervise the NBFC sector. So we'll deal with what are the important policy changes related with NBFC sector regulation by RBI. One is, okay, so the RBI Act 1934 have been amended, okay, which has strengthened the regulation and supervision of the NBFC sector by RBI. Okay, so RBI have been vested with additional powers in relation to NBFC regulation. Under this new norm, okay, RBI have set some conditions for NBFC sector. Okay, so regarding the minimum net owned fund or requirement for NBFC, okay, earlier the net owned fund, the minimum net owned fund used to be 2 crore, but after the amendment to the RBI Act 1934, RBI increased the minimum net owned fund of NBFC sector or NBFC from 2 crore to 100 crore. This is one important point, okay. Now under the amended act, each NBFC should have a minimum net owned fund of 100 crore. Earlier it was only 2 crore. Second changes is that, okay, RBI can remove the director of an NBFC from the office other than the government companies, okay. So any private NBFC's director can be removed by RBI. That power has been given to RBI by this amended act. Similarly, RBI can supersede the board of directors of NBFC other than government companies. Also, RBI can remove or debar statutory auditor, okay, from exercising the duties as auditor as of any of the RBI regulated entities, okay. Any of the RBI regulated entities, their statutory auditor can be removed or debarred by RBI. Similarly, RBI can resolve any crisis in the NBFC through RBI can decide whether regarding the NBFC amalgamation, NBFC reconstruction, splitting the viable and non-viable business into 2 separate units, all can be decided by RBI in regarding a crisis, NBFC crisis, when a NBFC faces any crisis. Also, RBI can direct an NBFC to annex its financial statement, okay. So NBFC, if it is a part of a group of companies, RBI can direct an NBFC to annex its financial statement, such as statement and information relating to the business or affairs of any group company of the NBFC, and to cause an inspection or audit to be made on any group company of an NBFC and its book of account, okay. So RBI can direct an NBFC to annex any financial statement related to it or any group company of NBFC. So these are wider power have been given to RBI to regulate the NBFC sector. Finally, RBI has been given the power to increase the quantum of penalty to NBFC. Okay, to increase, so the RBI may impose higher penalty to NBFC if they fail in any of the norms set by RBI. Okay, so after the amendment to the RBI Act 1934, RBI has been given with much wider power to regulate and supervise the NBFC sector. Okay, so this is very important policy announcement regarding the NBFC sector. That's the first thing. Okay, RBI Act have been amended and RBI's regulatory power over NBFC have been strengthened. Second important policy change regarding NBFC sector is that, okay, certain eligible NBFC, okay, non-deposit taking, systematically important NBFCs. All these concepts I have covered in your class, NBFC class. Okay, so all eligible non-deposit taking systematically important NBFC can now be made an authorized dealer. Okay, category 2 authorized dealer. Okay, so NBFC, certain eligible NBFC, that is non-deposit taking systematically important NBFC, can become authorized dealer category 2. Okay, so RBI have allowed certain non-deposit taking systematically important NBFCs to obtain this authorized dealer category 2 license effective from April 2019. So this will allow these NBFCs to increase, in order to increase their accessibility and efficiency of the services extended. See, NBFC provides many services. By giving them the status of an authorized dealer, it will increase the accessibility and efficiency of the services extended to the public for the day-to-day non-trade current account transaction. Okay, so any transactions of an NBFC with the customer can be made more efficient and made more accessible to the customer by giving NBFC this authorized dealer category 2 status. Okay, so all the eligible NBFC can provide. Okay, so eligible NBFC have to satisfy certain conditions and seek specific permission from the RBI to get this license. Okay, authorized category 2 dealer. Now third is regarding the RBI have come up with a liquidity risk framework. Okay, see, NBFCs from the mid of 2018 onwards is facing a liquidity crisis. Okay, NBFCs is facing a huge liquidity crisis. So in order to address the liquidity crisis, okay, a liquidity risk framework have been set up by RBI for NBFC. So we'll see that what is this liquidity risk framework for NBFC consist of. Okay, so it says that, so this liquidity risk framework is applicable to these NBFCs. Okay, all, so this risk framework, liquidity risk framework, is applicable to all non-deposit taking NBFCs with an asset size of 100 crore. Okay, so liquidity risk framework is applicable to all non-deposit taking NBFC with an asset size of 100 crore and above. Secondly, systematically important core investment company, this risk framework is applicable, and also all deposit taking. So we talked about non-deposit taking, all deposit taking NBFC irrespective of asset size. If you are a non-deposit taking NBFC, your asset has to be 100 crore and above. But if it is a deposit taking NBFC, irrespective of the asset you are dealing, you will be brought under the liquidity risk framework set by the RBI. So under this, they have all these category of NBFC should adhere to a set of liquidity risk management guideline. We will see that what are those liquidity risk managing guideline. They say that, okay, they should maintain a granular maturity bucket and tolerance limit. Okay, see, in this maturity bucket, okay, NBFC might have taken different types of loans through various debt instruments which will be having different tenures. So this maturity bucket is that, okay, so what RBI says that, okay, find out those debt instruments which will be maturing in the next 30 days and divided into different buckets, like the securities which will get matured in the 1 to 7 days, securities which will get matured in the 8 to 14 days, and securities which will get matured in the remaining 15 to 30 days. So keep those securities, liquid instruments, okay, which will get matured, okay, into different granular maturity buckets, and also keep a tolerance limit where certain fund has to be kept separate. So all these NBFCs should have a separate maturity bucket and a tolerance limit set aside to meet those maturity risk. Okay, then there has to be a liquidity risk monitoring tool or metric to capture the strains in liquidity position. Okay, this topic is only dealing with the liquidity risk framework. Okay, so there has to be a liquidity risk monitoring tool to be set up to know the liquidity situation. Then adoption of stock approach to liquidity. Okay, in addition to follow all the types of liquidity framework like structural liquidity. The NBFC should know its structural, how much liquidity it requires structurally, dynamic liquidity, as well as stock approach to liquidity, the stocks which it is dealing with. So every types of liquidity it need to adopt for the NBFC sector so that the NBFC will not face any liquidity risk. Then the extension of the principles of sound liquidity risk management. Okay, extension of the principle of sound liquidity risk management to aspects like off-balance sheet and contingent liabilities. Okay, all the liabilities including off-balance sheet and contingent liabilities as well as intra-group fund transfers will be applicable. The sound liquidity risk management will be applicable to these liabilities also. And also finally, very important, okay, liquidity coverage ratio have been introduced for NBFC sector. We have seen that liquidity coverage ratio have been introduced under the Basel III norms to banking sector. So the liquidity coverage ratio have been introduced for all non-deposit taking NBFCs, like excluding certain NBFCs, okay, all non-deposit taking NBFCs with asset size of 5,000 crore and above should follow this liquidity coverage ratio. Exclusion is, which all NBFCs have been excluded under the liquidity coverage ratio? And core investment companies, NBFCs are excluded. Non-operating financial holding companies, NBFCs are excluded. Standalone primary dealers and type 1 NBFCs are excluded. Other than these excluded NBFC, any NBFC, non-deposit taking NBFC with an asset size of 500 crore and above should fulfill this liquidity coverage ratio. Under this liquidity coverage ratio, all deposit taking NBFC, okay, so we talked about non-deposit taking NBFC if their asset size is 5,000 crore and above, but all deposit taking NBFC should, irrespective of the size, should have a liquidity coverage ratio to maintain a sufficient high quality liquid assets. So this high quality liquid assets will help them to resolve any liquidity stress. Okay, and this liquidity coverage ratio will be progressively increased to 100% by 2024. Okay, so liquidity coverage ratio, like in the case of banks, have been introduced for both deposit taking and non-deposit taking NBFC. For non-deposit taking NBFC, asset size has to be 5,000 crore and above. Deposit taking NBFC, there is no asset size has been considered. All the deposit taking NBFC, they have to maintain a liquidity coverage ratio, and the liquidity coverage ratio will be 100%. Basically, this liquidity coverage ratio is to have NBFC to have high quality liquid assets in their hand to meet any liquidity crisis. So if any instruments, financial instrument is getting matured, this high quality liquid assets can be used to pay back that liability. Okay, so basically these are the announcement regarding the liquidity risk framework. That is the third one. Fourth one is regarding the review of limits for NBFC microfinance institution. Okay, fourth important policy changes is regarding NBFC microfinance institutions. Okay, NBFCs which are microfinance institutions. Okay, so see, basically this NBFC microfinance institutions give loan to small borrowers. Okay, so when this microfinance institution NBFC category gives loan, they will look into the household income limit. So based on the household income limit, the NBFC gives more loans. So the household income limit for borrowers of NBFC MFI category have been increased from 1 lakh to 1,25,000 for rural borrowers. From 1 lakh, the limit have been increased to 1.25 lakh. So sorry, for the this is the income limit. Okay. So if the household, so the new household income limit is rupees 1,25,000 for rural areas, and from 1,60,000 the household income limit have been increased to 2 lakh for urban and semi-urban areas. Okay, so the household income limit have been increased to 1.25 lakh household income for rural in household, and urban household or semi-urban household it is 2 lakh. Okay, so the household income limit have increased. Second is the loan amount also have been increased for the borrower. From the earlier the loan limit was, lending limit for this microfinance institution was 1 lakh. Now it has been increased to 1.25 lakh both for rural and urban borrowers. Okay, with effective from November 2019. So NBFC microfinance institutions can now lend more from 1 lakh to 1.25 lakh, and the household income limit also for both the rural and urban and semi-urban areas have been increased by RBI. Now finally, housing finance company, the last important changes. Okay, housing finance company, which is also an NBFC. Okay, see, earlier housing finance companies were regulated by National Housing Bank, but with effective from August 2019, very important. Okay, housing finance companies are now regulated by Reserve Bank of India. Okay, housing finance company, I told you, okay, regarding the National Housing Bank. Okay, earlier National Housing Bank used to be the regulator of Housing Finance Bank. Now Housing Finance Bank is not regulated by National Housing Bank, rather it is regulated by RBI. A very important announcement regarding the housing finance companies. Okay, so there's a high chance that PSC can ask a question related with NBFC, but please revise the concepts regarding NBFC. What are the definitions of NBFC? Okay, etc. Okay, so that's regarding NBFC.